What you're looking at here is a chart of the S&P 500. This is a monthly chart, and oh boy, what a run we've been on for years since the 2008 low. But what does that do for valuations? Are we quite stretched? Why is the index so top heavy? Why do the big seven names make up the majority of the index, and as they go, so goes the market? What does that mean for us, and how can we best position going forward? We're going to dive into all that and more. Make sure that you hit that subscribe button so that as we present more videos and give more education, you're able to take advantage of that. So this S&P 500 chart is a monthly chart. Each one of those little candlesticks is 1 month's worth of trading, from May 1st to the end of May, from June 1st to the end of June. We can see we've been on an incredible run. In fact, if we were to look at this chart, there's a couple of key metrics here. One is this low. This was the 2009 bottom, happened in the March of 2009 era. This was on the back of the global financial crisis. So if you recall, in the fall of 2008, we saw Lehman Brothers, Bear Stearns collapse. We saw Citigroup losing billions and billions of dollars, Bank of America, all these companies. We saw a run on the bank at Washington Mutual. We saw all sorts of things. And the markets had been collapsing for months. You can see that the prior high, the market got more than cut in half. So from the peak of 2007 until we finally bottomed in 2009, we lost more than 50% of the S&P's value. The market has a wild sense of humor, and the low there in the S&P was 666. It was 666 points in the S&P, the devil's bottom there. Well, fast forward since then, and we've gone from the S&P index being worth 666 points to now 6,000 points. Just because it's up a lot doesn't mean, though, that it's overvalued. So we need to dig into valuations. We need to dig into how the index is constructed to really make a more well-informed decision on those points. So in doing so, we might look at the index and say, wow, the 7 biggest names in the S&P now make up a combined 20 trillion in market cap. To put that into perspective, if we were to go back to the 2007 peak, these 7 companies are 1.5 times larger. Those 7 companies by themselves are 1.5 times larger than the entire market, than the entire S&P 500 was, not at its bottom, at its peak, just some 20 or so years ago, less than 20 years ago. These 7 names, NVIDIA, Microsoft, Apple, Amazon, Meta, formerly known as Facebook, Broadcom, and Google, and you can see how tech heavy they are, how their symbols are 4, so they all trade on the NASDAQ. Google, that's the A shares, Google with an L. You can also trade Google without the L, which would be the B shares. These 7 names are an unprecedented 37% of the S&P 500. So they are a huge component. They're basically, as they go, so goes the market. Well, is that justified? Well, it sort of is, because they've produced 30% of the S&P 500's earnings. So they're producing a lot of the net income, the earnings that the entire index makes. But they're 37% the size. They're only contributing 30% of the earnings. They're trading at very lofty valuations. Their average PE multiple is 33.7 times as of right now. The index itself is trading at 27 times earnings with margins near record highs. Generally, you'll get a higher PE when maybe we go through an economic downturn and the E part, the earnings have shrunk. In this case, earnings are at peak levels, peak margins. So to have an expensive price when earnings are at record, it just doesn't give any room for a downturn. If the earnings falter at all, then that PE multiple is even worse than we think. Then if the earnings were cut in half, we wouldn't be trading at 27 times earnings. We'd be trading at 54 times earnings. Now, are the earnings likely to be cut in half in the short term? Well, probably not. but they can certainly go lower. We've already seen a recent jobs report where the jobs data was much worse than expected, and economists are currently, Goldman Sachs is an example, taking down their numbers immediately, projecting only 1% growth for the rest of this year. It just doesn't give you a lot of margin of safety. When things are trading very expensively, it's fine if the economy is robust, it's growing, and everything stays status quo. It is a big problem when you're trading at lofty valuations and we have any sort of economic downturn. So it's not that you can't make money, it's just that the margin of safety is not there. We want to buy when the market gives us a bigger margin of safety. And this goes to the way Warren Buffett summed up Graham's tale of Mr. Market. And this is beautiful. If you've ever read The Intelligent Investor, if you've ever read some of the books by Ben Graham, they are, even if they're written 100 years ago, they're so applicable to today. And I would point you towards chapter 8 and chapter 20. You go through those chapters specifically as a homework assignment. But Ben Graham, Warren Buffett says, my friend, a teacher long ago described the mental attitude towards market fluctuations. And basically, he called him Mr. Market. You're in business, essentially, with Mr. Market. He's a partner in private business. And without fail, Mr. Market appears daily, and he names a price at which he'll buy your interest or sell you his. So he'll say, I want to buy your business or I want to sell you mine. And every day he'll come with a new price. Even though the businesses that the two of you are in, maybe the economic conditions are stable, there's not a lot of change, right? Our businesses don't change a lot from day to day. The economy goes through some ups and downs, but sometimes Mr. Market shows up and he's euphoric. And you can see that he will sell you, or he will want to buy your business at an extreme price because he's just so optimistic. He's so euphoric. But then sometimes his mood will change and he comes in depressed and downtrodden and he says, I just want out of this business. You can buy it from me at rock bottom prices. I just want out. So there's the peaks and the valleys, and it's so much more important. More important than your knowledge is your temperament. And I love what Andy teaches here at the Cashflow Academy, where he says, be bigger than your money, where you basically want to have control over your emotions and you want to see the market for what it is. Sometimes the market will come euphoric and it will allow you to sell stocks at extremely high prices and give you an incredible opportunity to sell. And other times, they'll come to your door and they are depressed and beaten down and offering up incredible bargains at rock bottom prices. You need to understand where we're at in that metric. And my argument would be when you start to see all these SPACs and and crypto and altcoins and all of these different things that are just skyrocketing to the moon, that have no fundamentals, they have no income, no expenses, no cash flow, no assets, no liabilities. When these extreme valuations are happening, it's more of the euphoria. It's a better seller's market. It's better for you to be unloading than loading up. Well, we'll see. That's a long-term prognostication. It doesn't suggest anything in the very short term, but I always want to be acquiring assets. I've actually reduced some asset ownership and playing it a little more safe because I do think the day will come when Mr. Market will show up at my door depressed and downtrodden and offer me incredible bargains. But I need to have sold when the market was euphoric, and I suspect that's more of the market we're in right here, right now, as seen by this chart and others where we have been on an incredible run. If you were to use Elliott wave theory, where there are 5 massive waves, you could say this is 1 to 2. The third wave is generally the largest and most extreme, 3 to 4. And then the fifth and final wave before you get a big, deeper correction. Even if a standard ABC 1, 2, 3 type of Elliott wave were to occur, it would typically take you back to where wave 4 was. If we were to just look at that as an extreme, we would say that, well, if we went back to the bottom of wave 4, that would take us back to 3,600 points. Not quite the market getting cut in half, but down some 40 some odd percent from its current levels. If we were to even take Elliott wave and just look at it in the very shorter term pivots, we would say that, well, let me make it a little bit smaller, and let's change our color here of 1, 2, 3, 4, and 5. So hopefully you can see those. I know I drew over the top of them, but to show you, even if you were to take that, an ABC correction should bring us back to about 4,800. So whether you're looking at the long term or the short term, the ABC style correction should take us significantly lower in the not too distant future from our current levels. So be cautious, be careful. I think this is a time where the market's offering us incredible prices to sell and not as much so to buy. And we'll see how the markets go from here. But that would be my take, both fundamentally and technically. Hope you've enjoyed this video. And if you want an additional bonus, go to cashflowbonus.com. We have some free materials there. Cashflowbonus.com. Check it out. You'll get free education, free opportunities to check out some ebooks and things like that. Check it out at cashflowbonus.com. Hit that subscribe button. Make sure you subscribe so that you're notified and able to take advantage of these free videos to make you a better investor. We'll see you in the inside.